Hello everybody! This time we will see the famous book The Intelligent Investor by Benjamin Graham. The book was first published in 1949 and has been one of the most popular books on investing, with many investors praising it for helping them learn how to determine value in the stock market, including the famous investor Warren Buffett. Before we start, if you like the content of this channel, you all know what you have to do. Value investing. The main idea of the book is value investing, a strategy that targets undervalued stocks of companies that have the capabilities as business to perform well in the long run. The market is constantly moving from too much optimism, which makes stocks expensive, to too much pessimism, which makes stocks cheap. Buy when the stock market is low, from the pessimist, and sell when it is high, from the optimists. In the short run, the stock market is a voting machine, telling up which firms are popular and unpopular. But in the long run, it is a weighting machine of the real value of companies. Trading and keeping the shares only for a few hours is the main sure way to financial suicide. The only form of investor is the long term. Protection measure against the unknown in the future. Margin of safety. The future value of any investment depends on its present value. The more you pay, the less return you will have. Risk is an inevitable part of investing. You can't predict the future, but taking a margin of safety reduces the chances of things going wrong. This is done when you buy at a price that is much lower than the value you estimate the business is worth. Differentiation. Differentiation is not to put all the eggs in the same basket, but to buy different companies so that if something goes wrong with one of them, you are not destroyed. For differentiation in shares, you need from 10 to 30 at most. In addition, you should not focus on a single industry. Sometimes it's better to stick in a good stock rather than choosing many mediocre ones just for differentiation. It should not be an end in itself, but as soon as you choose good companies, it will occur naturally. What you can control. Unlike the unpredictability of the future, there are some things in your investment strategy you can control. Transaction costs, by investing rare, automatically and cheap. The property costs, by not choosing mutual funds with high fees. The risk, by deciding what percentage of your total assets you will put on the stock market. Taxation, by keeping your shares for a long time. Your behavior, by investing regularly and automatically. Having cash for an emergency on hand, so you never have to sell your shares. Intimacy. Invest in something you understand, and especially in what you know by first hand. Also, do not invest in foreign stocks exchanges. From the moment you live, work, and get paid in your country, you make a bet on many levels on the local economy. Emotion. Be patient and disciplined. Do not be influenced by market prices and the feeling of others in the valuation of your investments. Just use them to buy cheap and sell expensive. Do not be fooled by the lack of some investors. Among so many investors, by chance, some will have higher returns. 2 investment strategies. Defensive investments. Instead of reading company financial statements and constantly making decisions with the risk of making serious mistakes, choose stocks from a strong mutual fund that offers great diversification and professional management. Apply dollar cost averaging. You invest the same amount of money every month, so you buy more shares when they are cheap and less when they are expensive, so you get a better average price. Combine bonds with shares with a ratio of 50-50. Adjust it accordingly to whether you feel that the stock market is moving to the edges. Balance every 6 months. Ideally, choose an index fund that includes all the shares of an index. Observe the strategy of the mutual fund and its costs. Enterprising investment. You must analyze the company before buying its shares, as you would if you were going to buy the whole company. Let's not forget that the stock is a part of a business. The investor calculates the share price based on the value of the business. The speculator bets that the price will go up before someone else will pay more for it. There is no such thing as a good or bad stock. There is an expensive and a cheap one. The best companies should be sold when their stock is expensive, and the worst companies are worth buying if the stock goes too low. Important tips for stock picking. Low PE ratio. The capitalization of the company should not exceed more than 15 times the average profit of the last 3 years. Good management, which operates for the benefit of the business rather than the personal gain. economic strength, and capital structures. Assets must be at least double the liabilities. Also, the long-term debt must not exceed the amount of equity. Long history of dividend payments and high current rate. The value of the business must be, according to Benjamin Graham formula, less than the current earnings per share multiplied by the sum of 8.2 plus 2 times the expected annual growth rate. Strong brands, monopolies, abilities to provide a huge amount of goods at a low cost, intangible assets such as copyright, and to be irreplaceable, for example, public services. The company must be a marathon runner and not a sprinter. Its performance should be gradually have been increasing over the last 10 years. It gives a part of its profits for research and development. The share price is not more than 1.5 times the net asset value. Look at the ownership structure of the share. If more than 60% of the shares belong to institutions, it is dangerous because when institutions decide to sell, they do it massively, with catastrophic consequences. Practical trick for calculating intrinsic value. If you want to buy a stock, multiply the PE ratio by the price to book ratio and see if it is below 22.5. Conversely, if you know the earnings per share and the book value per share, then the maximum amount worth giving per share is the so-called Graham number, which can be calculated by the following equation. What I think about this book? This book is huge. It is the fundamental knowledge for all investors to evaluate a company and sets the principles for their strategy. The only thing I would notice is that perhaps the evolution of technology since its first release in 1949 may affect some of the criteria it sets. For example, in technology companies, net asset value does not play such a big role anymore, as most of their products are intangible or don't need large capital for their production. Also, in the mutual fund section of the book, if Graham was alive today, I believe it will include the current trend of the ETF, which is something similar but with significant advantages. My rating for the book is 5 stars in all areas. I don't think there is any serious investor who hasn't read it. Thank you very much for supporting the channel and see you in the next video.